Good morning, everybody.
Technical difficulties, James?
Yes, sorry about that. Sorry
Moment.
about the delay, everyone.
Oh, good. Well, thanks for joining us. Sorry that we're starting late, guys. This is, I think, part 4 of APAC Webinars for 2022. So we'll kick off since we're starting a bit late. A few quick intros if you guys haven't joined us before. My name is Pat. I'm one of the senior dealers on desk, and this is James. He's also one of the senior dealers on desk. We often combine our heads and run through a few key concepts and run through the events that's happening at the moment and go through what's happening in currency markets. How do you feel about today's session, James? What do you think is happening in the world?
I don't think anyone really knows what's happening in the world at the moment. I think that's what's creating all this uncertainty. So yeah, very timely that we're able to try and unpack a few things going on and try and make sense of this.
Well, lucky we're doing a webinar, eh? Cool. So what we'll talk about, guys, today, we'll talk about the volatility that we've seen over the last few months, what's going to happen over the next couple of months, talk about the US dollar story that we're seeing at the moment. James, our resident Englishman, will be talking about the UK and everything that's happened over there, from the change of leadership and the budget. We'll also go through the Eurozone. We all know what's happening in the Ukraine and Russia. Talk about the euro, fell below parity against the US dollar. We talk about the Aussie as well, and then we'll talk through a few emerging market currencies moving forward. I think it's been quite some time since we've seen volatility that we've seen over the last, say, 6 months. All of it's really triggered by, I would say, the Fed. Correct me if I'm wrong, James, but I really think the mistakes of last year with saying that inflation was transitory has led to the Fed raising rates faster than ever, and basically central banks across the world raising faster than ever.
Yeah, no doubt about that. You know, that so much monetary stimulus at the beginning of 2021, in spite of the fact that it already looked like the global economy was recovering and things were starting to get back to normal with vaccine rollouts and post-COVID, you know, for the money to just keep flowing into the market, you know, 12 months later, we're now stuck with too much money chasing too few goods.
Too much free cash in the market, I think.
But,
yeah. We also saw energy prices spike up to unforeseen levels, specifically around the Eurozone. A lot of that's to do with the current crisis in Russia and Ukraine, which actually drove euro dollar, so euro to USD, to go below parity for a period of time. I think at the moment it is slightly above parity, but we'll see how long that lasts. And also, well, the UK has been an interesting time over the last month. Was it 45 days, James, that Liz Truss was in power? And it was interesting 45 days, a few fiscal mistakes in my view. But now we've got Sunak coming in. You'll touch on that later on, but look, maybe we see a bit of positivity there, but a lot of uncertainty in the world at the moment.
Oh, absolutely. That energy crisis is I guess, wholesale. Gas prices have come off a little bit in Europe, but as we move into winter, particularly if there's some really cold weather snaps, you know, we'll see that come back, that issue raise its head again.
No, exactly. And talk me through the US dollar, James. Highest in 20 years. Has it got more room to go?
I don't see why not. You know, it is a particularly strange time at the moment with the US dollar having moved up so far. You know, the dollar index was at 90 in June of 2021. At the time, people were saying that it was the end for the US dollar as world reserve currency, that would perhaps the Chinese yuan or even a cryptocurrency would take over. And now here we are, you know, almost 30% higher. In the same way that people couldn't see a turnaround then, no one can really see a turnaround now, but things can change fairly quickly in financial markets, particularly when the speculators get involved. So Not saying that we're just that we're near the top, but things will change.
It feels toppy though at the moment, don't you think?
Feels toppy, but then when we broke through 100 and broke through 105, it felt toppy then, and all the indicators were saying overbought, and here we are, you know, it continuing to go. So it'll go as far as it wants to, in my view. And until some of the other currencies against which the US dollar trades start to see some underlying strength, you know, the US dollar will just by default be the safe haven.
I mean, we could kind of talk about, right, the yen's no longer a safe haven, being an energy importer. You're not seeing too much love for the Swiss franc as well. So I guess it's the USD that investors turn to for yield as well, right? I mean, what, over 4% interest rates at the moment.
Yeah, it's just a really easy store for value, and with gilt markets in the UK being so volatile and other bond markets, it's just an easy one. Buy US Treasuries, good yield. But yeah, again, things could change. But for now, the momentum is just building on momentum.
And I guess to segue from that, with the US dollar being so strong, I know a lot of our guests joining us today are importers. The volatility that we've seen has made it really hard. I know my clients at the moment have found it really difficult to forecast cash flows. You could be hedging as much as you can, but it's so hard to predict what's happening at the moment. What's your view on the volatility and how one should handle it?
I think that the volatility is probably a bigger problem, you know, particularly for importers with the Aussie dollar falling the way it has. But it's the volatility of it that's so tricky. Now, in 2019, we saw the Aussie dollar steadily wind down from 74 down to a low of 68. You know, a reasonable move in the market, but it was very, very orderly. Volatility was at a 25-year low. So as far as forecasting went, it was okay. But now with how
What do you
much
mean by orderly? So just constantly falling down?
The chart was very steady. It was just incremental decline. And you know, you could pick where it was moving. It was easier to make forecasts. You know, we would just see it gradually fall away, say 0.5 cent a month. But here, what we've seen, you know, just to trace back as far as May, 75 cents, down to a low of 66 in July, back up to 72 in August, and then suddenly back down, you know, into the low 60s again now. With most businesses actually budgeting for their FY23 back in May, it must be incredibly difficult to actually go in there and use a budgeted rate. So that's the volatility and the uncertainty.
Lots of repricing I'm seeing at the moment, especially with the importers side of the market.
Yeah.
And then let's segue to interest rates. Inflation is running hot. Inflation's the story at the moment. But I know my view on interest rate hiking, it doesn't make sense. Inflation's very much a supply chain story stemming from COVID, and it's an energy story. Do you think it's right that we've seen the rate hikes that we've seen this year, James?
I think I definitely agree that, you know, you can't print energy, you know, and it doesn't matter how you raise rates, you can't. But that there has to be, in my view, I think they do need to raise interest rates. I think people do need to be pushed and challenged in terms of, what do I spend money on? Do I just crank up the heating, or have I got to put a jumper on? That kind of thing, those kind of questions have to be put into people's minds. And I think while money's cheap, it's very difficult to do that. So I do still think that interest rate hikes were warranted. I just think we kept them too low for too long, and they didn't get them up early enough, which is why we're suddenly in a race to do it.
And with the Fed raising by 3% to now, and an extra 1.5% priced in, do you think rates are going to stay high for longer? And before we go into the details in other slides, the impact on the dollar, we know, is a yield story. Aussie as a risky currency, US as a safe haven, but with yield. Right now, do you see that staying for an extended period?
I think it's more likely over here. You know, if the RBA are going shallower, then I do think so. But I do just think that the US by this time next year will start to cut rates off a little bit. You know, particularly in the last cutting cycle, 2008. You know, it was only a year in between the last rate hike to when they were cutting rates. Things can change, you know, and the RBA, they got their last rate hike in at the beginning of 2011. And by the end of that year, they were already cutting as well. So, you know, you do tend to see it fall away fairly quickly once the peak has come.
I mean, this is an interesting table that I like to reflect on. You could have a look at, let's say, New Zealand, the US, and Canada that went super aggressive in raising rates, and inflation, unfortunately, hasn't tamed down. Aussie, for example, haven't raised rates as aggressively, but do you think our inflation's under control, and is that a big reflection on where the currency is?
Certainly not under control from what the number was the other day. In terms of goods, it absolutely flying, and it looks difficult for that to turn around. Thus far, those services hasn't gone up too much, but if it spreads to that, and no doubt it will in the coming quarter, then the RBA have got a job on their hands. So maybe they're not being aggressive enough.
And just for our guests here that, you know, aren't exposed to inflation and interest rates on a day-to-day like us, we know that, you know, central banks have targets in terms of where inflation needs to be. This is, again, a very interesting table showing that, you know, inflation in some countries are nearly up to double digits in other places. When do we start seeing a correction in this? It shouldn't be now, I don't think. I think interest rates take time to play into the market, but, you know, what's your view in terms of bringing back the target, you know, comparing the Australia to the US, for example, that the US are letting inflation just go through or just letting it pan out, where Aussie's trying to get between a target band between 2 and 3%.
I think what Australia is hoping for is that the rest of the world will do the heavy lifting for us. It's not a bad view. You know, our economy is still significantly smaller than the US and the Eurozone as a whole. However, just trying to wait for it to come down is quite a tricky call to be making. They need to not just get inflation to peak, but they've got to drive it lower a lot quicker. But then, you know, if a recession comes around, then as we see in every recession, prices go down and CPI turns negative. So that might have to be where they get to.
So let's talk about that then. I mean, recession's a very scary word to hear as a business as well. Typically in recession times, I mean, the last recession, big one around 2008, the Aussie fared well, but that was very much a commodity story. What do you think if we see a global economy, the recession in the global economy, do you think we'll fare well again? I know it's dependent on a few things. My view is there's a big dependency on China more than anything compared to the rest of the world. China has been cutting interest rates, so they've been very expansionary. But the thing is, how I like to tell the China story is they're living in 2021. They still have lockdowns for having a couple cases of COVID where the rest of the world has forgotten what COVID is, right? And until that changes, I think we'll continue to see a slowdown in China. But what do you think, Smiles? What do you think will happen if we do go to a recession? Where does the Aussie go from there?
I think the key is probably in energy, in that we haven't seen the rise in energy prices that the rest of the world has, that we can lean on our natural gas reserves. You know, we're a huge exporter of natural gas. And if that can be fed into the domestic market, then that certainly takes the pressure off in one area. If on the other side of things, goods prices can come back off, and that's reliance, I guess, on China to keep going with merchandise exports. And at the same time, if we can still improve immigration to, I know very basic, but backpackers to come in and take jobs, waitressing, bar work, that kind of thing. That's going to help keep services inflation down. So we might find ourselves in a stronger position. But that we're relying on a lot.
Definitely.
We're relying on a lot.
Cool. So you mentioned energy there, but let's hold that thought for when we get into Europe. But let's just go through quickly the US and the view of raising rates and inflation at the moment. Right now, I think there was a Wall Street Journal article about a week ago saying that the Fed might soften up. I've got a different view to that. I feel like they're on the set path. There's about 130 basis points, 150 basis points worth of rate hikes priced in. That gets the target rate to about 4.5%. I feel like when we're talking about a recession or a soft landing, I feel like we will see a recession and the Fed's trying to force a crack. I think we were talking about this the other day. And what do you think with that? Do you think we will see the 275 basis point hikes this year, or do you think the Wall Street Journal article that we read the other week was right and we'll see a pullback and a pivot, I guess people are saying, in interest rates?
Yeah, I think the pivot that people are talking about, though, is quite an optimistic one, in that a pivot from 0.75% hikes to just 0.5 or maybe just 0.25.
Isn't much of a pivot, right?
Yeah, nice. It's more a gradual turnaround. So that's the bit where I see it's difficult. I think the other thing just to bear in mind is that for the next 3 meetings, the Fed and the RBA have meetings in November, December, and February. But after that, the next Fed meeting will be in April. So the Fed kind of knows it's got quite a bit of work to do in the next couple of meetings, because after that, there's only going to be one in the first 3.5 months of next year. So the pressure's on.
That's an interesting point. So they have to get it done now. If they don't get it done now, they miss the boat.
Yeah. So the RBA is definitely helped by its more regular meeting schedule.
4 weeks instead of 6 weeks, is that correct?
Well, we basically go the first Tuesday of every month other than January. So, that just means that with 11 meetings a year as opposed to 9.
Do you count the next week's meeting as a meeting on Melbourne Cup Day, though?
No, I do. They've raised and cut before. In 2020, they were more than happy to cut the cash rate, even though it was Melbourne Cup Day, even though it was the same couple of days before the US election. And they did hike in 2010, I believe, as well. So certainly not going to be a non-event.
Fair enough. We'll keep that thought about the RBA when we get to them. I just want to briefly talk about the resilience in the US economy. I personally don't understand how it's held up so well. But what's your view on it? I feel like for some reason, inflation's been stubborn over there, and we've been seeing astronomical growth over the last few months or post-COVID.
I think, inflation's definitely been stubbornly high, but we are starting to see some signs. The PMI numbers the other day were negative. We've had a couple of negative numbers now in the last 3 months. Looks like most importantly, it's supply chain stuff that's really seeing the most negativity, which is great, considering how much that was gumming things up and pushing up prices. But I still think their big issue is because of the government spending programs that were announced, almost 2 years ago when Biden first came into office. Those are going now. The infrastructure program that they said they were going to spend $1 trillion on, that's in place, and that's creating work. It's creating jobs. It's creating goods demand. So, the government's efforts of a while back are going to continue to come into play. It's probably just the private sector that's going to struggle.
Yeah, exactly. You're right. I mean, let's talk about unemployment as well. I feel like that's the strong mandate that the Fed's trying to follow, rather than an inflation target or anything like that. I feel like once they see unemployment start to change, that may be when we see a move, don't you think? out of the Fed?
Yeah, I mean, it's slightly, but I mean, the continuing jobless claims, funnily enough, are actually growing. So it looks like once people have lost jobs, that it's a little more difficult to get back in, but new jobless claims has remained fairly strong. So there seems to be a way off until something happens. We're just not seeing any issues. I mean, I guess it's not like the last recession, 2008, the job losses first came in the financial sector and the real estate sector, and then suddenly there was just a balloon of job losses in the real economy. I don't necessarily think it's going to be the investment sector or the real estate, but one sector somewhere is going to have to see a big shock that's then going to get into the rest of the economy, and what that sector is going to be, we don't know.
Right, so it's a wait and see. I feel like it's still going to be hot for a while, the US economy, interpreting to a hot US dollar for a longer period, right? So let's talk about the UK, your home country, your hometown. Pound Aussie went to 159. Liz Truss has talked me through briefly what her budget was like and why it didn't make sense.
Yeah, so Liz Truss came in. One of the first things that she announced was that they were going to cut the top rate of tax, which was.
Does that make sense?
Well, I mean, even from a social perspective, that makes no sense anyway. I mean, it was a tax cut that nobody had asked for, and it was going to have to be funded with $40 billion of debt. And the Bank of England turned around and just said, well, I don't know how you're expecting us to find that money, considering that at the moment we're actually trying to shrink our balance sheet, not make it larger. We saw bond yields suddenly rise on the expectation that debt was going to suddenly increase, and that huge rise in bond yields created problems for pension funds over there. And so basically the government was forced by the market to reverse all of those measures. So a huge U-turn in the opening week or two of her prime ministership. She was then basically forced to get rid of the treasurer. So he had to go under the bus. But really over the coming days, people just felt that she wasn't fit for purpose. And we're now in a situation where they've got another prime minister in place. It's almost as if though, Rishi Sunak. So pretty historical. That obviously the first ever South Asian, or probably the first ever ethnic prime minister, which is fantastic socially. But from a perspective of politics, we've almost got forced stability now. They can't get rid of another prime minister, as you say there. We're on the 5th in 6 years.
3 in 2 months, 5th in 6 years. It's just ridiculous over there.
They're now forced into stability, because if this one goes, then there's going to have to be a general election straight away, and we're not due one for another 2 years. So in some ways, it's kind of a blessing for them. But really, what we're looking for is the budget. They've actually delayed the budget by several weeks so that they can probably buy time, but try and come out and announce some fairly tough measures. One of the ones is they have a triple lock on pensions. What that basically means is that if inflation goes up by 10%, then pension contributions by the government have to go up 10%. So with inflation now at that level, they're sort of forced to increase that. That's an enormous burden. And again,
they have to find the cash from somewhere, right?
Yeah, they have to find it from somewhere. So I think the speculation is that they've given themselves 3 weeks to basically soften the public up to the fact that they're not going to be able to meet that absolute triple lock commitment. So if they can go through with that, it's going to be massively unpopular, but it won't be unpopular with the financial markets. And that's why at the moment, the pound has actually come back a little bit.
It's quite funny. I feel like Truss completely ignored financial markets and underestimated the power of the bond market, and definitely paid the price for it. But the pound and bond yields are definitely reflecting more positivity with Richie in power, and I think I share the same view. He was my original tip to take over from Boris. So I'm glad to see him in power again. Like you said, it's great from a social aspect to get someone of minority to be prime minister. I guess my fear with it is, like you said, next general election is 2025, 2024. It's really difficult to see the Tories get re-elected again as it stands right now. What could happen in a few years, I don't know, but right now it doesn't look great for them, does it?
No, not at all. I mean, they probably won't stay in, but they've got 2 years basically, and they'll want to take that full 2 years, and and they can only do that if Sunak's there to the end.
And just really briefly, Bank of England meet next week. We expect a 100 basis point hike. Do you think they'll move the currency at all, or is it fully priced in?
No, it seems to be fully priced in. The decisions have been unanimous. They basically vote, the 9 members vote, and they actually publish the votes, and it has been unanimous all through this year. So yeah, they have to do it. The market's expecting it, and it's just required to get inflation down. 10% is incredible, really.
Oh, let's go over to Europe. So the theme I know from our European offices has been a cold winter. And that just really goes to the price of energy. That Nord Stream pipeline, which currently isn't pumping any gas into the Eurozone. But what are your thoughts with the euro at the moment? Inflation can get up to about 15%. Some say they've been historically one of the most dovish central banks. They hiked by 75 points last night. There's a view that they can go more, but I feel like there's just so much downside risk to euros at the moment. I wouldn't want to be an importer over there. I feel like if you're an Aussie importer and you've got suppliers in China or suppliers that you pay in USD, if you could find a supplier in the Eurozone that's actually producing, you'll save on the currency, but the reliability is a bit difficult in terms of production. But yes, Roz, what do you think about the Eurozone over the next couple of months with the winter season coming up over there?
Yeah, I guess the one saving grace is that at least the natural gas prices come down, as you can see on the chart on the right. I mean, that would be completely unsustainable for their winter if we were going to rise that much. But if there is further disruption to supply, then that can rise very quickly. There's so much doom and gloom about the Eurozone, though. I just feel that there has to be something that can pull them out of it.
Which is what?
Well, I mean, that's the thing. Who knows? That you've got to look at, are there any positives to what's going on at the moment?
Depends what happens with Russia and Ukraine, right?
Yeah. Well, I mean, you've now got a war on your doorstep, and that keeps things down. Absolutely, no doubt. Particularly if there's contagion. And I think the most important thing from these rate hikes is that what that's going to do to the peripheral European countries. I mean, geographically.
You mean
peripheral.
like the pigs and those
yeah.
type of, yeah.
So I mean, obviously Greece in particular, where there was a massive amount of debt that's rolled over for a long period of time now, since 2010 when they had their debt crisis, and you're now looking at the cost of servicing that debt has rocketed. We've seen more in the terms of interest rate increase in the last 2 meetings from the ECB than what we got from their entire 2005 to 2008 rate hiking cycle. So it's a massive shock, and it would be interesting to see what happens on the debt side of things. We've not heard anything yet, so that could be the spark that might even affect the rest of the world.
Yeah, I know my view on the euro back in my uni days as well has been a currency that just doesn't work. So many different economies with different monetary policy requirements. You just won't be able to basically make it work across 20 different nations, with Germany with inflation through the roof, and the pigs where it's an issue if interest rates do go up because they just can't service the debt, like you said. So we'll see how that pans out. But I mean, right now we just don't see inflation slowing down. Again, an energy story. How do they fix that?
Yeah, they can't print energy. So unfortunately, we are where we are with that one, and that's what's creating inflation, particularly in Germany for producers, a big manufacturing hub. If energy prices are going to remain high, then that's going to feed through to the rest of the world. So
No, exactly. That's enough about the euro. Let's talk. I know everyone here is interested about our views on the Aussie. And I say this time and time again, the Aussie has been collateral damage this year. To be fair enough, we haven't gone too bad as an economy. But unfortunately, if you trade risk, you trade the Aussie dollar. And if you are saying it's risk off, you sell the Aussie. You get carry now against the USD because of the interest rates. But that's what it is. How do you like describing the risk proxy story of the Australian dollar, James?
yeah, well, I think what's interesting on your first point there about it being a commodity currency, we definitely saw some real strength in the Aussie at the very beginning of that Russia-Ukrainian conflict, because
Oddly enough, right? Because it was risk off.
Yeah, because of commodity prices going higher. Everyone looks at this and goes, brilliant. Australia is going to be a massive beneficiary of this. And that's how we got the Aussie into 76 cents. But I think then when there was the realization that the markets to pick up those commodities were collapsing and that the sustainability of those prices was not there, and that it was going to be more around supply as opposed to demand, that's where it's fallen away. Very, very important that there actually is demand for commodities. And with China at the moment, the way it's going, looks like demand right now is going to be way off. So that's essentially why the Aussie dollar is falling, even though on the whole, a lot of commodity prices are high.
But I feel like that China story is not going to change, not until they decide to stop putting people in lockdown, in my view, because Chinese factories are nowhere near capacity at the moment. And there's just too much uncertainty in terms of what production you could get out of China, right?
Yeah, absolutely. There's until we're clearer on where they're at, then it's going to be extremely difficult. But I think that's something again where perhaps we might be overestimating how much China are stopping production. It might well be that they turn around Chinese New Year next year and just say afterwards, right, Chinese New Year's done, let's get back to work.
I think so. I feel like, we'll give our closing points at the end, but my view of the Aussie between now and Chinese New Year and after, that's been my catalyst event for a long time. But let's talk about the RBA just quickly. Next week's meeting, are we seeing 25 or are we seeing 50? I know that the federal budget you mentioned this week sees the RBA rates to peak at 3.35. What are we saying after this week's inflation figure?
I think the markets looked at that inflation figure and said, well, they've got no choice but to get back to those 0.5 increases. I'd say the only thing against that is that we only receive our inflation number quarterly. We're talking about activity going back to July, which now is almost 5 months ago. 4 months ago. So it might be that the RBA just kind of holds its nerve, sticks with the 0.25 or even less. But I just think the fact that it is a live meeting, that they haven't indicated anything. I mean, that's been the characteristic of this RBA hiking cycle all the way.
He loves scaring the market, doesn't he? Or surprising the market, rather.
Yeah, exactly. They really like to play with the market. So that's the danger here. But then that's also why we might see a fairly swift move.
And just closing off the story about risk and I guess emerging market currencies, we continue to see a sell-off. We haven't really seen emerging markets play off well. It's a risk-off tone at the moment. That is expected to continue. The interesting thing enough, and when we say this to our clients all the time, if you are importing, if you are dealing from countries like the Philippines, India, Indonesia, there is a benefit to actually paying those emerging market currencies, right? The USD has come off, the Aussie has come off so much against the USD, but there is stability. Trading in local currency. How do you think, Swirls, with our clients that have made that shift of paying in local currency, they haven't really felt the brunt of the US dollar appreciation this year, haven't they?
Yeah, not so much. It's been fairly useful for those clients. I guess they have to be in industries where the suppliers are willing to accept that local currency. But where they do, it's definitely paid off because Aussie Chinese yuan has not moved so much. We kind of do move together against the US dollar just due to the correlation between Chinese economic fortune and Australia's.
No, exactly right. Exactly right. And that's the end of the webinar, guys. I guess to leave you with something, James, your call for the Aussie, the economy. I know this, I'm looking at the list and a lot of the people here are importers. What are you saying? Do we see 70 cents soon or not?
No, I still think we can be a way off, but one of the things is with the Aussie, it's always surprised us over the years. It moves very quickly and things change in the blink of an eye. We've talked about all the factors: inflation, war, global supply chains, COVID, etc. But I think one of the things to just be really important to remember is that a year ago, when surveys came round, when economists were giving their predictions for 2022 at around this time of year, there weren't too many saying that a conflict between Russia and Ukraine was going to completely destabilize the situation. So I think the most important thing is we can see what's coming out in front of us, but as businesses, as importers, as exporters, we need to be able to control what we can and not be at the mercy of financial markets and their reactions when something comes up out of nowhere, like COVID, like a conflict.
I mean, you know my view. I'm quite specific. I'd like to think I know where everything's going. My closing remarks for the Aussie is between now and, like I said in the middle of the webinar, Chinese New Year, I feel like it's Aussie off. You guys would have seen the articles come out over the last few weeks about seeing the currency below 60 cents. I feel like if the story plays out with the Fed and the RBA being dovish, then 58, a 50 handle basically on Aussie US is possible. But I have strong sentiment to believe that after Chinese New Year, we'll see a big turnaround, to be, I guess, the positive one on the desk. If China reopens, COVID is easier, and we see the Fed pivot then hopefully we see a 70 handle. I mean, I'd be biting my lips if I'm wrong, but I don't see it being a far off possibility. So seeing 70 by, call it June, July could be a thing. So what I'm telling my clients, I see some of you guys are in the webinar, is, you know, just have a look at your exposure till Chinese New Year, protect the bottom line. And then from there, let's see what we look like for FY 23, 24. And that's it. If you guys have any questions, our email's there. Feel free to reach out. Always happy to have one-on-one conversations about the markets. And thank you for attending. Have a good Friday. Thanks, James.
Thank you.